Welcome, everyone, to this week's edition of the Commercial Real Estate 101 Meetup Group. For those guys who are tuning in for the first time, we actually started this group back in 2020, and ever since then, we've had speakers come from a variety of different to cover a variety of different topics pertaining to commercial real estate. And today, we have the honor of having Reid Bennett from, I believe you're located in Chicago.
Yes.
Focused on the multifamily asset type, and we're going to dive into the discussion of how multifamily is doing currently, where we see it going, and maybe some of the topics pertaining to ways that we can, that as brokers, navigate some of these murky waters that we've experienced over the last, call it 12 to 24 months. So, Reid, it's an honor to have you. And again, thanks again for taking the time. I know you had a national meeting that was taking place earlier this morning, and you were able to make some time today for us. So I appreciate
Absolutely.
it.
Hey, I'm honored to be on. I've been watching what you're doing, especially on social media, which is it's just a fantastic way that we can all keep track of each other across the country when we never could do this. So I really appreciate you having me on, and looking forward to the discussion today.
Absolutely. So, first off, we usually take the first little bit of the podcast to kind of give us an opportunity to get to know the person that's across the table from us. And, obviously I've followed you for quite some time. Obviously you provide phenomenal insight on in LinkedIn and Twitter as well. But for those individuals who don't know you, if you could share a little bit of insight into that'd be great.
Sure. So I started in the business in 2001, and I worked for a smaller boutique firm, and we sold multifamily properties in the neighborhoods of Chicago, corner walk-up buildings, courtyard buildings, corridor buildings in the city. I started, really 2002, 3, 4, 5, 6 was all a big condo craze. At least here in Chicago. And I've mentioned this before to a number of people that I literally thought, it's not that I thought, I knew in my mind that there would be no multifamily, that every single multifamily deal was going to be converted into condo, and I was going to have to figure out what my next asset class was. And that's how fast things were converting in Chicago. I mean, I had 176 condo converters on the northwest side of Chicago in my database. 176 just in a small area of the northwest side of Chicago. And it was everybody and their brother and sister and grandma were all getting into it. And the music stopped there. And that got me into, and I've told people, I didn't even know how to underwrite a multifamily asset the first 5 years in the business, because it was all based on square footages. And so I would just laser measure all the square foot areas of the building. And we were selling the buildings before I even got income and expenses on that building. So I went and got my CCIM and completed that from 2006 to 2008. And then that kind of led me into understanding how to underwrite multifamily complexes in the suburban markets. And then we moved out across all of the Midwest is what we focused on, 50 to 250 units. Now we focus mostly on 100 units plus. And then I took over the National Council Chair position for a company called SVN. And what I do with that is I work and collaborate with a number of my colleagues around the country. And we've sold deals from El Paso, Texas to Raleigh, Durham to Syracuse, New York. And everywhere in between, where we collaborate on a national basis. And it's really helped our business, my team's business here, because we can take any one of our clients that not only focuses on the Midwest, but looks at other markets around the country. We can ramp up quickly in those markets with the boots on the ground that we have around the country. And then from that, we've been just collaborating with, a number of individuals, especially if they are kind of jack of all trades and working all asset classes in the market and know everybody, and they're geographic specialists. Sometimes they bring us in to team up. We just closed a 459 unit portfolio in Montgomery, Alabama, with one of our partners down there that runs the office in Montgomery. And that was the 7th deal we worked on with him. So it's been really fun to learn different markets, because multifamily is the same everywhere with the exception of geographic nuance. Mm-hmm. And you have to understand that when you go into a new market, otherwise you can get crushed, because if there's something that you typically don't understand when you're in the Sun Belt region, then you come up to the Midwest, and you don't understand the boiler systems and which ones are better and whether tenants are paying heat versus the landlord paying heat, and how you underwrite deals, because it makes a big difference on the expense ratios of your underwriting and all the other, we call them sanity checks when you're taking a look at deals. So I don't know if that was that's it in a nutshell right there.
No, that's amazing. And offline, we were kind of talking. They're actually currently, as we speak, there's a national conference where you have managing directors coming in from all over the country from offices of SVN, and it gives you guys an opportunity to continue that collaboration piece. So you'd mentioned you'd done deals with people from all across the country, and I bet a big piece of that is because of the emphasis you all put on that fostering of that type of culture.
100%. And it's interesting because the first, I would say, 6 years of my career in brokerage, we were a boutique firm, and we didn't work with anybody else. I mean, we didn't collaborate with any other office. We never co-opted any deals. It was all, just working with the 6, or so people that we had in our office. And I just remember going, why am I going to this national conference and going to be, just talking to a bunch of brokers? And I didn't get it for the first couple of years. And then when I would, go to when I'd go to them and not just sit there and kind of just listen to the guest speakers, when I'd started interacting with the other, the other advisors around the country and realize, oh, okay, so they have a client from LA that owns in Chicago, and we're going to get, they're going to open up the doors and we're going to get to the table with that owner of the LA, or, in LA, when I never would have gotten to them sitting here in Chicago. Maybe I tried calling that person, 50 times and never got through to them. And then once I realized the collaboration and where we could expand and really utilize just different data points. I mean, if I had one of our clients here in Chicago was looking to buy, a lot of people they call them snowbirds. They come from, as they come from the Midwest and they go down to Florida or they go out to Arizona, during the winter. But a lot of these owners, they still have multifamily in their blood and they can't stand not looking at deals. So when they go down to Naples or they go to Fort Myers or Miami, they want to look at deals down there. So now I just hook them up with one of, oftentimes I have one of my colleagues who will pick them up at the airport, drive them around, show them some products, just, say what's going on with that market. And, we do a deal that I never would have even thought to think about tracking deals in Naples or Fort Myers or, something like that. So it just opened my eyes that, collaboration and really abundance even in brokerage, because most brokers, they'll get the listing and then they're going to hold it, and they might push out the listing to maybe their top 10 buyers to start with. And then maybe the next 50, and, maybe the next month they're going to go out to their own database and they're trying not to let anybody, and then maybe they'll put it on LoopNet, or if they don't get any offers in the first 2 months. But it's, if you're pushing, you're not doing the best service for your seller if you do it that way. So, casting the widest net, getting the most eyeballs looking at it, trying to find every corner of the country. And, we just closed on a portfolio with an international buyer. If you're not exposing deals, because not one person can say they know every buyer that's going to, buy this particular asset that you list. We can say we know every single owner, in 100-mile radius. You can say that, but you don't know that one of those buyers in that 100-mile radius is going to be the one to buy that. You don't know if there's a family from New Jersey that their kids are going to University of Chicago, that while they're in Chicago picking up and dropping them off, they're saying, look, I want to buy an apartment building, for my son or daughter to own and operate, go to school. Basically, he's going to be living and going to school there for free if we can, generate an asset that eventually pays for itself and then gives us, cash flow in the interim. So it's like, you don't know that family from New Jersey that never bought in Chicago. So that's why you just need to cast the widest net. You need to know all of the people, or expose deals for your sellers to the widest audience out there.
Yeah, no, 100%. And to your point, I mean, commercial real estate historically may have been very localized
Yeah.
and just regionally centric, but nowadays with the advent of a lot of these technologies and how information is so readily available, it really is something that you could live in Texas and buy in Chicago, you could live in Florida and buy in Kentucky, you could live
Yep.
in California and buy in New York. So, and there's a lot of people out there that have the resources to be able to do that. So to your point, it's of course best to be able to make sure that the broadest possible audience can see what you're offering, because at the end of the day, that's going to be a best service to your clients. So
Yeah.
I couldn't
I
agree
mean,
more with.
100%. And to your point, being a local business, you know, I was probably the youngest by I think 22 years when I came into my office. But I would look at all the historical deals that had closed for, 30 years prior to me even getting my license. And when I looked through all of the deals and I mean, they had basically multiple listing services on sheets.
Mm-hmm.
It was
Yeah.
not digital, right? So I would look at those, and every single apartment building was 5 times gross rent. I mean, that was the only metric they used. So it was very simple. You knew as soon as you got that owner to sell, the only way to analyze the deal was 5 times gross rent, basically.
Mm-hmm.
And everybody else would complain if it got any lower than that, or any higher than that multiple. And then, so what I realized also in the multifamily space is there are so many different execution strategies. We're also in the affordable housing space with the low income housing tax credits and project based Section 8 HAP. And just for the low income housing tax credit of the light tech world, there's two different directions that you can bring a market rate, an older market rate asset with deferred maintenance that's sitting in what's called a qualified census tract. If it scores well, you can do an acquisition rehab utilizing the state credits to bring elevate that property where no other market rate owner or buyer would be able, the math wouldn't work to put as much money in as a low income housing tax credit buyer will do. And then vice versa. That once these credits start burning off after year 15 for the initial compliance period and then into the extended use period, we have groups that there's a number of different execution strategies for those. A lot of groups are coming in and doing what's called a qualified contract and taking them out of the program and going back to market rate. Others are resyndicating them and moving on, and some just warehouse them and wait for the affordability to burn off. So what I've realized, and I was just talking to you, a friend of ours that out in Kentucky about, you can't be, unless you are in a tiny geographic area, you can't be a generalist. You can't be a generalist in a major metro. So, and then what I realized was, even as you get into a certain asset class, it's niched out even deeper and deeper and deeper. I mean, multifamily is a kind of a big umbrella that covers, affordable housing, market rate housing, class A, class B, class C. You can have student housing, senior housing, and in every one of those niches, it probably divides up even more. Some groups will look at deals that are 6 to 20 units. Some will do 20 to 80 units. Some will not do anything less than 100, and they niche into those areas. So if you're not niching, they say the riches are in the niches. If you're not doing that, then you're going to be going up against somebody that's all they do, is that particular niche. They have all of this information and data about what's going on with that niche that they're going to be able to way outperform somebody that's going from medical office to retail to leasing, and then just kind of jumping ship. And we call it the shiny object syndrome in CRE. It's very difficult. I mean, especially with the amount of time it takes to ramp up in this business, as it's difficult because each market kind of has a golden child. So some years it's industrial, and when Amazon was just blowing up all over industrial was the best asset class in the world. Some years when I was getting my CCIM in the early 2000s, there were 3 guys at my table that all did medical office, and they showed me what they were doing with the medical office, and they actually were structuring deals and going in, and I was like, this is awesome. I want to do medical office. And then I realized, like, okay, there are medical office teams that are coming in and just going to dominate, everybody that I'm talking to. And then the same thing with every other asset class. So if there's anything you have to niche.
Oh, absolutely. Yeah. And I think that's the only way you could truly scale to a high level, because, to your point, you're never going to be able to provide the same level of value that someone who does that full time is going to be able to do, especially if you're hopping from one thing to another. And I've started to realize that as my career has progressed as well, because, as you know, I started kind of at a boutique firm. I'm currently at that, but over time I've started to niche more into the retail space. And I'd say 80 to 90% of what I do now is retail centric. And I've made sure that in my marketing and my communication with owners, with my communication with prospective clients, that's what I'm projecting, is that I'm, this is my area of expertise and this is what I can provide for you. And, over time, that's what I'm going to be focused on. Because again, and another kind of point that you had drawn up is, what made you decide multifamily was the area that you wanted to focus in, or was it just kind of by happenstance?
It was something that I could understand, because when I first moved, I moved to Chicago in 1999, and one of my roommates from college, I went to the University of Iowa. He stayed around. We call a lot of my friends stayed back for their victory lap, the fifth year, and he bought a house the fifth year and rented it to all of my other knucklehead friends from college, and they all paid his mortgage. And then I think he ended up buying 47 homes and rented them out to students, and then parlayed that. So, I was really interested in what he was doing. And then he sent me the, Robert Kiyosaki's book, Rich Dad, Poor Dad, because that just, I wasn't thinking of it in the right way. And that just got me in a totally different mindset. And so I started looking at 3 flats and 4 flats, because if you buy anything 4 and under, you can get a residential loan, maybe 3% down, live in the unit and rent out the rest and pay for it. So I just started looking at those. And then I ran into a couple of the guys that were running the multifamily brokerage, and they just said, look, you don't want to focus on these small ones. You want to go into the larger apartment buildings, and then eventually invest in those rather than, go that path, which either path is fantastic. But I could understand multifamily. I always say I'm not smart enough to figure out the rest of the asset classes, but, multifamily, I could understand it, because, somebody's paying rent, it's usually an annual lease. So you can adjust to the market a lot quicker than some of these 5, 6, 10, 15-year leases in, office and retail. I just could understand it better. And I just saw how, especially in Chicago, I would go out every Saturday and Sunday morning when I first started, and I would drive up. I had these big zip code maps, and I would just drive up and down the streets, and I could see the buildings, and I could understand, I could stand outside of a corner walk-up building and tell you exactly where the 5-room 3s and the 4-room 1-bedroom units are outside of that building. And it's just, ever since I got into that, I just never wanted to do anything else. I mean, I thought about it. I had kind of that shiny object with the medical office. And then during the great financial crisis, 2008, 9, and 10, we were seeing that the GSA, the government leased buildings, were doing well. And so I said, look, I have one of my owners does that, wants to sell one of these. It was an ODAR facility in Indiana. And he's like, can you sell this? I said, absolutely. And then even that, though, once I started like diving in and trying to help him sell that deal, I just realized there were like 20 other groups that's all they did again. And so I just kept coming back to multifamily, because it was something that, the firm I started at, they were 100% multifamily. They really didn't do anything else, maybe a couple land plots here and there, which that's another asset class that I don't have the intestinal fortitude to sell land, because it takes so long for those deals to close. You have to have your pipeline so filled. But, it was just multifamily was something I could understand, and I just stuck with that. Even when times got bad, I just stayed with the multifamily.
That's amazing. Yeah, no. So our office, we do a ton of land and also retail. But
Yeah.
we're more of a generalist firm. But I'd say like our focal areas are retail and land, a ton
Okay.
of land. So I could attest to the fact that it takes forever to get some
Yeah.
of those deals done.
Yeah. I mean, we
But
closed a 43 acre parcel that was slated for 1,000 units.
Mm.
And it took us probably 2.5 years,
Yep.
and that's just like, I mean, look, some of our affordable deals take 2 years, 24 months. And you just, I say to my business partner, I'm like, I'm so sick of talking about this deal. It's been 2 years. And then you have to go through all of the, the land,
Entitlements and all that
yeah,
stuff.
the entitlements. And then you have all of the people that don't want to have a certain product type built there. And it's a lot. It's a lot to go through. So kudos to you for getting, some of those deals done.
Yeah, no, it's been fun, and I on the land side, I've done not big land plots, but I've done a lot of outlot stuff, like
Okay.
retail outlots and such. So going through all this covenants, conditions, restrictions
Yep.
for the development, and having coordinated with all the different stakeholders that if you have to modify the documents, you have to talk to like Meyer, Target, all these other corporate entities, and
Yeah.
they don't care about it. It'll sit on their desk for 6 months unless you just keep on top of them. So
Yeah.
it is what it is. You just gotta have to modify you have to keep pressing and try to get it to the finish line. And sometimes it works and sometimes it doesn't, but you got to just keep going. But one thing I was curious about is, obviously, as we're recording this, we are pushing into September of 2024, which is kind of amazing. I feel like this year has just flown by,
Yep.
but over the last 12 to 24 months, we've obviously experienced a period of not necessarily stagnation in commercial real estate, but interest rates obviously drive a lot of the sales activity within commercial real estate because commercial real estate is so debt driven. And so we've seen transaction volumes drop over the last 12 to 24 months. Obviously that's affected a lot of different property types. I'm kind of curious as to what you've seen over the last 12 to 24 months in the areas that you focused on. And maybe if you could provide some insights to that, that'd be great.
Sure. Well, it's going to vary depending on what area of the country you're talking about. But for example, the biggest, and everybody tries to compare what's been happening to the great financial crisis and how, what the differences are and the similarities are to both, sets of time. But the thing that I find was the biggest challenge, and I go out to a big multifamily conference each year called NMHC, and this last one, and it's usually like the end of January. So the year before this January, this was when all of those rate hikes were it was just like every month would be a rate hike, and it was 50 basis points, 75 basis points, 50. And everybody was going, what the hell is going on? Like, what should we do? Because my exit cap rate, was based upon interest rates being, 4.5%, or below. And so everybody kind of stalled. And last year, so 2023, the deal volume was down. Well, it's tough to compare year over year because 2022 and 2021 were ridiculousness as far as deal volume and pricing. And so when people compare 2023, it was down 63 to 77%, depending on what market you were in the multifamily space. And that's crushing, right? That's, because so you have all of these syndicators, you have all of these groups that hired, 10, 15 acquisition groups, you have title companies and real estate appraisers and all these people that weren't doing anything. So it kind of crushes that market because everybody was sitting back on their heels, all the buyers, because the thing in a market like that is the buyers are very nimble because they're the ones going to get the debt quotes to buy your deal. And the sellers are a lot slower to understand what the impact of, a 500 basis point increase from the Fed, in 14 months does to the value of your property. Because the buyers are going, I was just getting 2 cap offers yesterday on my 1982 vintage deal that needs a full gut renovation, and we were offering those. We were offering sub 3% cap rates in the Midwest. on 85 product that was just dilapidated, which is just insane. So overnight, that went from a sub 3 cap to a 7 cap. And so, but at the same time, it also affected the housing stock as well. So everybody in 2021 and 2022 that got a 3% or a 2.5% 30-year fixed loan, they're not selling. It's like rent control. They're staying in their house. So the inventory of homes just went down, even though more homes weren't being developed. The inventory was just virtually non-existent. So the prices skyrocketed. The interest rate skyrocketed, which was interesting that we saw, especially in my neighborhood here in Chicago. It's like they were still achieving record pricing on homes when the debt went up 3 or 4 times what it was in 21 and 22. And so that's another thing that we saw. So what that did, when housing is now out of reach, the tenants in multifamily complexes that would be buyers, home buyers, are now forced to stay in their rent, or they're forced to be renters in that apartment. But the other thing was the rents were going up. So, the owners are even on the renewals, they were raising rents $100-$150 a month. So the owners are saying, why am I going to accept this guy's offer when it's, 25% below what I was being, like, unsolicited offers were like being thrown at me. And now you're telling me that just because these buyers have different, debt vehicles, that they're only gonna, I'm not selling this deal. I just raised my rents $150 or more. So my deal is cash flowing like crazy. Why would I sell at that price? And it was hard. I would say, you're right. If you have this is not the time to sell. And in 2023, I told more people not to sell their deal than I told not to sell their deal since 2002. Wow. All in 1 year, because I couldn't argue with them. I was like, look, the metrics of your building are fantastic. You're crushing it. The only caveat to that was I would ask them, the 2 main expense line items, right? Taxes and insurance. Insurance is just out of control right now for multifamily owners. So, and oftentimes, and lately, so definitely through this year, 2024, the assessors are catching up to the ridiculousness of the pricing of 21 and 22. And so now you're getting hit with a new tax bill because taxes are all in arrears in most areas. And so now you have this tax bill that's substantially higher. Your insurance bill is substantially higher. Your payroll, people are, I don't know what people are doing, but we have a lot of owners that are offering, up to 6 figures for managers right now in secondary and tertiary markets, which is just absolutely insane. And they can't find people to fill in those jobs. So it's like you have all these heightened expenses that are now washing all of the double-digit increases that we saw over the last 5 years. So that's one of the problems. And then if you have a loan that's coming due, I think there's $83 billion of multifamily that are coming due in 2025. You're now looking at a cash in refinance. And so if you're not flush with cash, you're going to have a problem right there. And so that's what we've been trying to help all the multifamily owners across the Midwest that we're talking to. We have a thing called the Midwest Multifamily Matrix that we're helping them identify ways to maximize that NOI so that they're ready for any situation that's going to happen in 2025. If they're going to if they have to refinance a deal, we need to jack up their NOI because they're going to get a smaller loan to value ratio based on that number. So if they can increase that, they're going to be ready for not only a refinance, but they'll be ready when, I think they're going to be a ton of opportunities coming next year from the sale side.
Yeah, I've been getting, I've subscribed. I've people that I've known in the space, and I'm subscribed to some emails from different syndicators. And I've seen in recent months emails from syndicators saying, hey, we have a unique opportunity. We're looking for additional capital to essentially debt capital to add to the capital stack, because they're likely going to be going into some form of refinance in the near term, and so they're asking you investors for XYZ amount of money, and we're going to give you 12% interest on your money, and it's going to be positioned behind the bank debt. And again, that's part of what you're talking about, where it's the bank loan is likely coming due. Whether or not the lender decides to work with the syndicator remains to be seen. Some banks are deciding to pull back their interest in certain property types and different areas of the country. And, you don't want to risk the idea of not having that as an option. Therefore, you're raising capital preemptively to make sure that you're not having to sell your asset before it's ready. And especially in a lot of these situations, and I'm sure you deal with a lot of investors like this, where they're in the middle of their business plan. They buy the property, it's underperforming, they want to flip over units, and maybe they're 60% of the way there, 70% of the way there, but the time's starting to tick away, and they're like, oh, if we don't do something preemptively, then we could be caught with our pants down in the next year, and we'll have to sell at a discount and potentially lose out on whatever the investment is at that moment in time. So and you can comment more on that than I can, I'm sure, but
I mean, in the last, I would say 6 or 7 years, I've never seen more syndicators get in. It's like, I know there are all these seminars that are out there that it's like, you can be a syndicator and you can be a syndicator. All you got to do is team up with me and just find the deal. And I noticed that because we were getting, when I would ask, so how are you underwriting this deal? I would get the exact same spreadsheet from these seminars. Some of the guys didn't even remove the tag of who created that spreadsheet. And so I was seeing a lot of this, and I was like, oh man, look at the assumptions that they're making, 9, 10, 11% increase assumptions on their income. And they're also making assumptions that their expenses are going down. And they also are making assumptions that it's going to be a 4 cap on their exit in 5 or 7 years. And I was looking at all this, and because I going through the condo craze when, for example, the condo craze got so ludicrous that some of the condo converters we were selling deals to would figure out, here's what I'm putting into the building, my soft costs, hard costs. Here's my profit. Go put this property back out on the market for that number. And we were getting it. And we're like, holy crap. So that's kind of like what I was seeing with the syndicators, what they were starting to pay for deals. And in every single cycle that I've seen, you see certain buyers and you're like, how can they pay that number? And you're like, is there some kind of magic that they're doing? And then you find out maybe a year and a half later, when the banks are taking it back, oh, they couldn't pay that price, but they did. So, I have a feeling, and I've been there are a couple syndicators that have reached out to me that said, look, I got my LPs into this deal at this number. Can you underwrite it for me? My bank loan is $13.5 million. I bought it for 15 or 16 million bucks. Can you get me my debt? And I would underwrite it, and I'd say, look, if the stars align perfectly on top of your deal right now, I think you're at 12. So, and this is if you are 100% occupied. So it's like, there's no updates that you can do to this deal that's going to get you to the position where you're even going to be worth the debt that you have on this property right now. And I think there are going to be more of those people. And the lenders for in 2023, and even for the majority of this year, if there were deals like that. But again, the metrics are robust with multifamily, where the income was still coming in. If the lenders were smart, they just would try to figure out how they can extend that loan. And we called it extended pretend in 2008, 9, and 10. The only problem is you can only do that for so long, but the banks do not want to take title. They don't want to get into the chain of title of some of these deals, especially if it's in, maybe a really management intensive area. I'll never forget in 2000, it was 2009 or 10. There was a bank. It was a pretty big bank here in Chicago that took over a deal in the south side of Chicago. And it was, we call them California style, where it's like motel, where you walk right in and it looks like a motel. So they had a stairwell, and a lot of the tenants knew based on the notices they were receiving, that the bank now took this over. They took it back from the landlord. And, one afternoon, it was in disrepair and the whole stairwell fell down. Right. And I think it was a 25-unit building. Well, 22 of the tenants are all laying in the yard once they saw that thing go down, because they knew they could come after the bank and sue them. There weren't 22 tenants standing on that railing, but, they all were laying in the yard, waiting for the Channel 5 news to show up. So that's one of the reasons why the banks don't want to get involved in these, because they don't know how to run them, even though they put in a special receiver during these situations. But usually it just tanks the value of the property. We even had receivers during that time period that I knew of that would get into a building. They would drop the rents by $200 for everybody. And they're saying, look, I got this building now 100% occupied. We'll just buy it from you. Take it. And then they just jack the rents back up to 200, and they just probably made $3 million by buying it direct from the bank as receivers. So there was a lot of that going on. I don't know if that went on in other cities, but Chicago kind of has they have people that were willing to do that and get away with it.
Yeah, I'm sure. And to your point, I mean, it's not an optimal situation for the bank. So if they see, from what I understand, and again, I have yet to go through that myself, candidly. I got into the business in mid to late 2019. Obviously, COVID was kind of a weird situation, but then 21, 22, to your point, was bonkers. I mean, really in the investment space, if you were, regardless of what property type you were looking at, I mean, things were just flying off the shelf, really. So, I'm interested to see how it will play out over the next 12 to 24 months. And that kind of leads me to my next question, which is, what are some of the things that you think will need to be done? And maybe we could talk more broadly on the Fed level, or maybe just, maybe on your local side, things that your city and municipality can do to help kind of alleviate some of the strain that's going to be coming down the line over the next 12 to 24 months. I'd love to hear your take on it.
Yeah, well, I mean, my personal opinion is that the Fed is about 6 to 12 months behind the reaction timing that they should have. I mean, there was no reason that interest rates should have remained as low as they were throughout 2021 and 2022. I mean, when I was seeing, cash out refi with, multiple 7-figure cash outs on deals when they were, 2.75% interest rates, it should not have been that low for that long. Same thing on the back end of it. They hold out too long to reduce the rates. Because they're waiting for things like the employment numbers to come in, and all of a sudden the employment numbers are just readjusted, 800 and some thousand jobs off. That's a little bit of a mistake there in the math. But usually you have, scholars that are running these things that don't own businesses, that don't really understand, but they're the ones controlling a lot of that. So I think they're late to raise them, and they're late to lower them until there's been a lot of damage done. But Powell and everybody are indicating that this, September is going to be an interest rate reduction. See, all buyers and sellers want is some semblance of normalcy. They just want to have just some understanding of what's going up, or what's going on with the rates. And are they going to? Sure, they'll fluctuate a little bit, but when they're just going up and down like they've been going, you have no understanding of where things are, and everybody's making all of these, prognostications about what's going to be happening. You just want to have a normal up and down historical interest rate situation here. I do think they're going to be coming down in September, and then we're hearing, whether that's going to be 25 basis points or 50 basis points. I would bet more on the 25 basis point side, and then another one in Q1, which it should spur a little more activity, because I know a lot of people are waiting. They're just waiting, like, okay, I'm not going to put my property on the market until we have this first interest rate hike. And then that way, once we get into the marketing, it's going to take 30 days to get the property out to the market. And then we're going to be negotiating back and forth. And by the time it gets into contract, we might have another dip. So, the buyers at that point are going to be in an even better position than they were when they started negotiating the contract, which is always better. It's always better to catch a market where rates are dropping, than when rates are going up and values are dropping. So it's going to be interesting. It's going to be interesting to see what happens, because I think the drop in the rates isn't going to increase the values. I think it's just going to level them, because of all the increases on the expense side that we've seen. So, but I'm hopeful that happens, because the other thing is, especially in multifamily, when multifamily sellers sell, especially if they're older and have had the properties for a long period of time, they tend to do a 1031 tax deferred exchange into less management intensive asset classes like triple net deals, retail deals.
Mm-hmm.
So that spurs a whole set of activity from selling. So now and that's the beauty about commercial real estate, are all the mouths that are fed off of one deal that's sold, right? You have not only us as brokers, but you have the seller, the buyer, you have the attorneys that are working on it, you have the title companies, you have the appraisal companies, you have all of the phase one companies. And then majority of the time they're doing a tax deferred exchange into another deal, which, so that is going to put more money in the pockets of brokers and title companies and appraisers. And, that's a lot of the things that a lot of the politicians don't understand when they try to attack the 1031 tax deferred exchange, is that actually, if you're able to defer those gains, it kind of puts the seller at a frenzy to buy new deals to, bring more money into the economy wherever they're buying that new deal. Just from I made a list one time of all the people that are affected by one real estate transaction and that make money off of that for their family. And it got to be a very lengthy list. I'll share that on LinkedIn, because you don't think of all the people,
Mm-hmm.
and then you have the contractors that are going to come in and do the rehabilitation of the properties. And, with retail, when you sell a deal, there's all these guys coming in to do TI, and there's new businesses that are coming in that are going to hire more people to work at the restaurants and work at everybody in the strip center. It's just, you don't realize the impact that one single real estate transaction has on the entire economy.
Yeah.
Or on a certain sector of the economy.
And also, to your point, the property assessment that takes place thereafter. So
Sure.
like in our market,
course.
and I'm not sure if it is in Chicago, but once a property sells in a particular a year, the
Yeah.
following year it's reassessed.
Yes.
So there's an increase in tax dollars that are flowing into the economy as well. And so
you guys have it reassessed every year?
No, it
okay.
reassesses when there's a sale, but typically it's every 4 to 5 years is when we
Okay.
have, more standard reassessments. And you could always fight the assessment if for whatever reason you're able to justify why that's the case.
Right.
But yes, if you achieve a sale number, that'll be recorded with the property, the local assessor's office, and then they'll use that number. Usually like 80 to 90% of that assessment is going to be what you are currently newly assessed at.
Yeah,
So,
absolutely. Which is another good point. So, you're talking about increased tax revenue coming in on every one of the sales. And that was another thing that here in Chicago, they were trying to, the administration was trying to implement, they called it the mansion tax. It was every deal over $1 million was going to, I think it was quadruple the transfer taxes. So, I can't believe that they didn't realize that a 2-flat that a mom and pop owner has had for 40 years in Chicago is probably going to be $1 million in most of the neighborhoods. So it's like, you're not putting a mansion tax on, a $10 million home on the lake. You're putting this mansion tax on a lot of the smaller investors throughout the market. And that's not what an area like Chicago or Cook County needs, is to have less eyes coming in, investors to come in to improve the properties. We need more eyes to come in and think about it. But when you start slapping on all these taxes, and here in Illinois, it's they're not supposed to chase the sales, but everybody does. So you'll be reassessed at the new value. And even if you use, we use an archaic kind of way to back of the napkin quickly figure out a multifamily tax bill. If you are somewhere between 15 and 17% of your collected income, and that's your tax bill, it's tough to argue. So, if you're selling a deal that, somebody has owned for, 10, 15, 20 years, their tax bill might be below 8% of their income. Right. So, on a larger transaction, you're going to take that property from, 7, 8, 9% of the income is what the tax bill is to now 15%. So you're doubling it. So that's bringing double the revenue into the local municipality. That's significant. So, and that's just what boggles my mind when they talk about this 1031 tax deferred exchange, and when because it comes up here in Chicago all the time that they're going to eliminate. It comes up nationally. They're going to eliminate that. But what they don't realize, so then that's just going to make people not transact. They're just going to keep it and say, fine, I'm going to milk the hell out of this building. And that's really in essence what rent control does. Rent control, you're sitting there as a landlord, and if you cannot raise your rents to a certain level, you're going to say, well, I don't have enough money in the coffers to redo the stairwell. I don't have enough money in the coffers to redo the sidewalks, and I can't do it. So then that's when you get just properties that have so much deferred maintenance. But you have tenants that have been living in there for 15 years that are paying $300 a unit. It's not the case. And if you look at what they're paying in San Francisco and New York for a railroad apartment, we call them railroad apartments where they don't have any hallways. You're going through the bedrooms to get to the kitchen, and what all of the roommates are paying, $5,000 to live in these junky apartments per person. In some cases, it's just, how is that working?
Yeah. Well, it dissuades new development from taking place. And it's already hard enough to develop new product to begin with, because you have to deal with, land entitlements, a lot of NIMBYism about multifamily as a whole, even though I think it's somewhat unwarranted. A lot of owners of single family homes, there's a new proposal for an affordable housing community that comes to market. There's always some people standing up at local council meetings opposing the development. So having to overcome that is already a challenge for developers. But now you slap on another layer saying, oh, well, you have to maintain a certain level of rent control for whatever product you're bringing to market. At some point, it's just like, okay, unless there's significant help on the, either LIHTC side or what other incentives you have, like, it just doesn't even make sense. And so why even waste our time to try to bring new product to market, which is going to help lower the cost of housing. That's the whole point.
It's simple. It's what you learn in the most basic economics class in high school or college or wherever you want to take a simple economics class. It's called supply and demand. Mm-hmm. If there's little supply, there's a high demand, you can raise that price. We are 4.5 million units shy of what's needed in this country. And then the other thing, and Yardi Matrix is great at putting out this data, and I share it all the time on social media. They put together the kind of the stack of all of the costs associated with a new development. And about 40% of the cost is the bureaucratic red tape they have to go through to entitle a piece of land, go through all of this junk to get the project developed. So if you can remove let's just say you remove 20% of that, it's only 20% to do all that. The cost goes down to develop a multifamily apartment building or complex. Therefore, you build more, as we're finding out in the Sunbelt regions. When you build more, the rent goes down, and the big bad landlord that everybody is trying to come after, ends up having to compete with each other for tenants. That's kind of what you want. And that's what a lot of the politicians that are imposing these rules, they don't understand it. I see it over and over and over and over, and they're trying to pander to their constituents. I'm helping you. I'm helping you. I'm helping you. But what they're doing is they're reducing the amount of stock, which is increasing the price no matter what they do on the rent side. So
it's headlines is what it comes down
Yeah.
to. It's, it's a lot easier to sell the idea of, oh, look what we've done to restrict the amount of increases we can achieve on the rent side for you all. So you feel good inside. You say, oh, well, as a whole, this particular legislation is going to help us in the long run. But the unintended consequences of decisions is a lot of times what people don't really take into consideration.
Yeah.
And again, it's playing out across the country in various markets. I mean, we don't necessarily have that issue yet here, but I'm sure in the future there could very well be proposed legislation that could affect the way that rent is proposed in our market. So
I mean, it's 100%. And then the other thing that you brought up about the affordable housing and the NIMBYism that goes on with all of the other people that own homes in that certain market. There's a misperception about what low-income housing tax credit housing, the light tech, or it's called Section 42. There's a very big misperception as to what that actually is. So what light tech deals, or the low-income housing tax credit deals, when you see those developed and you go out into the suburban markets, and I'm sure there's a bunch in your backyard I can show you on the HUD maps, you drive up to it, you will not know the difference for the vast majority of an apartment complex that's market rate or an apartment complex that has tax credits that were used to develop it. They still have a clubhouse. They still have a pool. They still have, a nice garden. They have a lake in the middle of it. The difference is when the developers of those, then they're incentivized by receiving a certain amount of credits per capita of your state that can go into it otherwise, which wouldn't make it financially feasible to build workforce housing is what it's called, or, lower income housing. But it's usually set aside for those that are at 60% or below the area median income, or the AMI. Well, 60% or below in certain markets is the dental hygienist, the teacher, the fireman, the police officer, the server at the restaurant you go to. I mean, that's a majority of those individuals are 60% or below. They're not, they're not what all these, these NIMBYs that are coming out saying, we don't want this developed. They're thinking it's just going to be, food stamps and all. It's a totally different concept that I think if maybe it's politicians that have to help bring light to exactly what a light tech development is in that market. But, the other thing is today's Class A turns into tomorrow's Class B, turns into next month's Class C, which then gets re-syndicated with tax credits to be brought back up to a Class B, but set aside for those that are making less than 60% of the area median income, which again is often not what you think it is. So
especially
I can talk
nowadays,
about this stuff all day.
Yeah, it's especially nowadays. I mean, it's the average family, especially with inflation the way it's been acting. I mean, there's a lot of people that are struggling, and so being able to provide that type of opportunity to people is huge.
Yeah,
and I think that, to your point, I think a lot of people are short-sighted in the way that they're approaching it, and again, I think overall, being able to take an approach that we are open to development is only going to benefit the municipality long term. And so, yeah, I mean, there's this we could talk about, I'm sure, all day.
Yeah, I'm sure.
Yeah, but one last thing I wanted to kind of touch on. I know we're running up right on the hour, so I want to be respectful of your time. But regarding really the people who listen to our podcast, a lot of commercial brokers across the country. There's a lot of investors and people who are part of the commercial real estate industry. So I guess one question I had for you, I know you're obviously very active on social. You've been coaching. I believe you're with you coach with the Massimo Group as well, and you've been helping brokers your entire career kind of navigate these waters. I mean, what type of advice would you give to those individuals who are currently in their early on in their career and are trying to navigate these waters as they're currently in?
So there's a couple pieces of advice, and the first is especially for the new brokers into the business, you have to treat this business as if you're going to graduate school to get your MBA. It typically, if you're full time to get your MBA, you typically can get it in 2 years, right? And I haven't checked into what the costs are, but a lot of people that I know that are going to Kellogg here at Northwestern, you're paying $100,000 a year to go to get your MBA. So that let's just take 100 as a round number for both years. All right, let's say you can get your MBA for $50,000. That means you're paying $100,000 in 2 years and not making any money unless you were doing something on the side. You have to look at CRE like you're getting your MBA, with the opportunity that you might hit a deal in that first year and likely in your second year that's going to generate money for you. So you're going to be net positive than if you were to go get your MBA. So you have to understand it's going to take you 2 years. I'll never forget the story that John McDermott told me. He's I call him the godfather of SVN. He coaches a lot of brokers in SVN. And he was telling me about, I think it was a broker that was in the business for maybe 15 months, hadn't made a deal, was leaving. Like he was just totally deflated, leaving his office after everybody else, like 6 o'clock on a Friday. I'm quitting. I'm not coming back Monday. Goes down, gets his car, drives down the parking garage, gets to the gate, and he doesn't have the $1.50 or $2 or whatever it was to get out. So he had to go back to his desk to try to find change. And he went back and he saw the light beeping on his phone with a message. And the message is like, "Hey, you've left me a couple postcards. You've called me a number of times. I'm ready to sell my deal." It ended up being like a $3 million deal. And it started his career. And he made, 7 figures, moving forward from that. So you have to hang on. You have to trust the process. You have to either align yourself with somebody that's done it and is doing it, get on that team, or get coached, or both. Because you don't know what you don't know in this business. And if you're getting coached by someone that has a process that you can follow, and so you know that it's not me. When I got in the business, it's, hey, there's your desk, there's a phone, start making calls. It wasn't a systematic approach as to how you're gathering the information, how you're targeting people, what are you saying, and then what's the systematic approach to how you're saying that, and then how do you get the meetings, what do you do it's truly amazing that any real estate deal gets done in this market, in any market. But if you're not following a system, working with a team, or being coached by somebody that's done it, your learning curve is going to be that much greater. So get that early.
Definitely. No, I appreciate that.
A long-winded answer to your question about
that.
that.
It's a phenomenal answer. And I appreciate you providing that context. And I think sometimes putting it into perspective is super helpful because, to give you context on my previous background, I was in engineering for a long time and then got into the commercial brokerage space in 2019. And I remember when I first started with my brokerage, my broker sat me down, and he said, this is kind of my background. He ran a popular restaurant in town for a long time. And then he got into the business actually later in life, closer to 50. I think he was 49 when he got in the business. And he said, look, my first year I made 15 grand. My second year I made 40 something. And then the third year I kind of got going and I started making over 6 figures. And he's like, I had 3 kids, actually. I had a wife, we had other bills, obligations, etc. So I just want to provide this to you to say that, don't get disheartened by the fact that you're putting in a lot of effort early on and things aren't playing out the way that you envision them to, because, you may see someone who's been in the business for 10, 15 years and they're crushing it, but you don't look at all the things they did on a day-to-day for years before they actually got to that point. And so, I really appreciated that when I first sat down with him, and I think it helped me navigate some of those early, times where you're making no money. I think I tell people all the time, I think I made 13 grand my first year. And that would, luckily I did the fourplex thing that you had talked about, where I lived in one of the units and ran out the other 3. So it helped me kind of navigate some of those early times. But I do appreciate the insights you shared there, because I'm sure there's a lot of people out there that can really value that message.
Yeah. So. There are 2 things also to add to that. So most brokers usually leave 3 months before they'd hit it. That's what we see in the market. because it's a business that you're going to get 99% no's, and that's difficult for people to take. But you have to understand that 1% or maybe 2% of the yeses can make your career every year, right? And then the other thing is you have to also realize what's happened recently in the brokerage community. Over the last 3 years, 20% of the national brokers have left the business, and probably 30% or more of the boutique firms brokers have left. So, and I remember that's what happened in 2009 and 2010 we cut our brokers in Chicago by about half. So everybody that was, not making money or not making enough to survive has left. They're out. So if you can hang on long enough, you're going to have a whole open market where you can grab much more market share than you could in the heyday. You always want to be getting into this business on a downturn. You never want to be learning or trying to learn when it's hot, because either the senior brokers in your office or that you're trying to learn from, or the owners of the office, are so inundated with deal maintenance, they can't help you or walk you through a deal. And here's what we're doing, and let's work on our structure and strategy. But you can when you have, when deal volume is down 70% from the previous year, you have a hell of a lot of time to figure out, okay, let's retrench. Let's figure this out. Let's learn, start databasing and figuring things out, because that's the other thing. If you're getting into it and there are deals being made left and right, and all the senior brokers in your office are making all these deals and you're not, you take like a bigger hit to your ego about what you're doing. So, you'd much rather get into this business, and it'll always become a better business moving forward. There's always a brighter day. There's always a market that goes up. And the other thing to think about is everybody's talking about AI, and AI is going to totally eliminate the need for real estate brokers. Well, I heard that in the early 2000s when LoopNet came out and really was getting steam, and everybody was like, there's going to be no need for you brokers. All we have to do is put our property on the market, on this internet, and then a buyer is going to find it, and we're going to create a frenzy of buyers on the internet. I had one client tell me, I need you, because you're dealing, especially in commercial real estate, you're dealing with two egos that are relatively large most of the time on each side of the table, that they're going to take us as brokers, and you probably attest to this. We get a guy in one ear that looks at a contract and is insulted by it. And he's like, tell that guy to go whatever,
all the time.
And they'll yell and scream in this ear. And then we take it into our head, and then we go out on this side to the other guy and we say, he really didn't like point 2 or 3 on your contract on page 4. He wants you to adjust that. Where when these groups start talking to each other, they blow up a deal every day. And so there's always a need for brokers to first create a market, because that's the other thing. Sometimes we're delivering 25 plus offers. If you don't know how to get those offers down to the top 2 or 3 deals with groups that are not going to waste your time and retrade, because, my dad was a principal, and he told me, he's like, and he was a teacher. So he's like, what, you guys don't just take the highest price? I said, no. Sometimes groups will come in well above the rest of the field, tie you up for 30, 60, 90 days with no ability to close the deal. So now if you're trying to come back, especially if the market's diving and you just lost 60 days on the market with a buyer that didn't have the capability to close, you're now sitting there going back to buyer 2 and buyer 3, and they're like, what was wrong with the property? Well, now my offer is this, which is not usually higher than what they offered before. So that's what the need is for brokers moving forward, and to make sure that you're, really maximizing the value and not leaving, really a dime on the table for your seller.
Definitely. No, I couldn't agree more. I really appreciate that insight, Reid.
Yeah.
But well, first off, thank you again so much for your time. Obviously, we greatly appreciate your ability to be here with us today. I know you've got a few things to take care of this afternoon. So again, we do appreciate it. So if people wanted to learn more about you, maybe follow you on social, whatever other, method to be able to get in touch with you, what's the best way to do that?
Yeah, follow me on LinkedIn. I have a QR code on my homepage that gives all my contact information on my LinkedIn header. So go to LinkedIn. All my information's up there. You can also go to the SVN website, find me there as well. LinkedIn is usually the easiest way to get a hold of me, just because everything's right up there for everybody. So
that's awesome.
Connect with me. I'm
Oh,
open.
we will. And I'll make sure to include it on the show notes. So if you guys are watching this on YouTube, it'll be in the show notes. And if you guys will listen to this in a podcast format, whether that's Apple Podcasts or Spotify, it'll be in the description. So feel free to connect with Reid. And again, he's a wealth of knowledge. And if you don't follow him on LinkedIn, you really do, because he does, all his posts are very, very insightful. So
Awesome.
Reid, well, thank you so much for your time. Thank you to everyone who's been following along with this podcast. If you guys like this, please like and subscribe to the channel. It really does make a big impact on our ability to reach a broader audience. And if you guys are watching or listening to this in a podcast format, leave a 5-star review. It does make a big difference in our ability to reach a broader audience. And thanks again so much for your time, Reid, and we'll see you all next time.
Thanks, Raphael. See you later.